I'll explain how interest rates negatively impact the property market. 2, why interest rates are only one factor and other factors need to be considered. And finally, what's potentially in store for the couple of months? A slowdown in growth, but no crash. Let's dive in. Interest rates are the lowest they've ever been, and the RBA has raised the rates for the first time in 11 years. The ultra low rates we've seen this previous decade were just a temporary measure, but definitely not normal. A rise in interest rates is a sign the economy is doing better. It means we are finally out of that emergency state where the RBA was doing everything it could to stimulate the economy, and now we can finally return to normal business. Now let's look at 3 ways how interest rates can negatively impact the market. Firstly, first homeowner inexperience. These are the homeowners most stressed by interest rate rises. They've already stretched beyond their means and could only enter the market due to low interest rates, and they have no experience with rate rises. The last one was 11 years ago. Secondly is a negative wealth effect. When people think their assets are falling in value or not increasing as much as they would have expected, they then tighten their spending and may reconsider purchasing that additional investment property, etc. So there's a decrease in demand from buyers. Thirdly is reduced borrowing capacity. Let's say you could borrow $1 million before. After a 1% rate rise, you may see a 5% decrease in how much you can borrow. So that $1 million would drop down to $950,000. This would obviously lead to a decrease in buyer demand. However, what we need to keep in mind is that interest rates are only one factor which impact the property market. Let's consider 3 other factors which are having a positive impact on the market. Firstly, high savings ratio. Currently we're sitting at a 13%, which is double what we averaged last decade. Owner-occupiers make a large proportion of the market, 70% actually, strongly dwarfing first home buyers. These owner-occupiers have good savings in place to weather this storm. They have enough in their offset accounts to sustain rate hikes. Plus many have experience with previous real estate cycles. Secondly, incoming immigration. 200,000 visa holders will be coming to Australia as borders reopen. They will of course require housing. Thirdly, low unemployment. 3.9% is very low. This leads to better loan serviceability and positively influences demand. So what's the forecast? Interest rates will likely increase steadily, so there'll be plenty of time for the economy to adjust. Growth will slow down, but there won't be any crash. Thank you so much for watching. Now, if you liked the video, please hit the like button. And if you want to see more videos, please subscribe. And if you have any video topic that you want me to cover, please let me know and I'll seriously consider doing it. Thank you.